You know, if you're borrowing money from your whole life policy, you're probably doing it the least effective way. And what do I mean by that? Well, we're always teaching the infinite banking concept by borrowing money from your policy. And I'm not saying that's wrong, but is there a better way to access the money in your policies? Can you access more money than what the insurance company will give you? And if you have multiple policies, can you actually consolidate them all into one central place where you do your private banking? Well, that's what we're going to talk about in today's webinar. So come on, let's do it. Welcome to Wealth Webinar, where we teach you how to take back control of your money. And today we're going to do just that. But today we're going to talk about a topic that has, to me, been really important and something I wish I had learned back at the beginning when I first started this. You know, I know we're going to be talking about creating a private banking system, or as some of you know, the late R. Nelson Nash's book, Becoming Your Own Banker, and teaching you how to become your own bank. Okay. Now, with that, the one thing that all of that hinges around is changing one thing and adding one step. That one change is where your money goes first, your savings specifically. So right now, a lot of you are saving money in bank accounts. And I know it's been a great place to save because banks have actually paid you decent amounts of interest. But as Jerome Powell and the Fed starts decreasing rates, you're starting to feel the pinch a little bit where your high yield savings, when the Fed drops rates, goes down with that. So all these are components of why we use specially designed and engineered whole life insurance policies from mutually owned companies that pay dividends, is because they simply pay more. And the tax advantages of life insurance certainly help. I know all of you, if you could just snap your fingers and say, hey, my bank account, my high yield savings account is now going to be tax free. Every one of you would take that. Well, you can't. You get a 1099 INT every single time you earn interest in your bank account. But within the policy, if built properly within the IRS rules, which we do this properly, you're going to have tax-free growth of your cash value. But the thing is, you know, listen, I don't know many people that want to pay premiums in terms of an expense to then protect their lives so that someday when they die, their family gets more money. Now, I know that's a noble and a very good thing to do, and I know we all need to do that, but isn't it better that you can put your money somewhere, your premiums, but deposit them where you have access to a large percentage of that money, right? Well, that's what the specially engineered part is. When we design these policies, we design them ultimately for high early cash value, meaning you make a deposit today into your policies, premium deposits, you could take that money immediately in the first 30 days or anywhere there in between the first 30 days. But when you do that, you're going to take that money as a loan from the insurance company. The loan basically is the insurance company giving you money from their general account. Okay. When they give you money from their general account, they subtract it from your death benefit, which is really cool because the insurance company, the way they operate, they know because they've guaranteed you in a contract, they have to pay that death benefit out someday when you die. And we will all die, just so you know. No one's getting out of here alive. It's funny to say that, actually scary to say that. Hopefully it takes a long time for that to happen. So the death benefit has to be paid. And the only way the insurance company doesn't pay the death benefit is if you stop paying your premium. So great. Let's fix that. Let's make it so your premiums are premium deposits into the policy so that your family's protected with the death benefit someday. But while you're living, we have access to that money. That's why you have a bank account. You put money in your bank account so you have access to the money. Access to the money to go on vacations, go to the movies, go out to dinner, whatever. Well, that's why you save money in a bank account, right? Well, we're just changing where that money goes first. And then we're using the insurance company's money, i.e. using our future death benefit while we're living. The insurance company only has a simple few rules. When we borrow from the insurance company's general account, i.e. from our death benefit is another way of saying it, the insurance company mandates that whatever amount we borrow, we have collateral. And what is collateral? Collateral is something saying that if we run off, if we cancel the policy, the insurance company's made whole. That collateral is simple. It's your cash value, okay? Your cash value in the policy is growing. It's compounding. It's earning guaranteed interest plus dividends at a rate of, depending on what company we put you at, with 5.9 to 6.6%. That's the dividend crediting rates today. And today is January 2026. So the cool part is we get to use our money by borrowing from the insurance company while still earning on our money. Very different than any other place your money exists, because every other place where your money exists, you put your money there, but when you want to use it, i.e. a bank account, when you want to use it, you take the money out of the bank. Doesn't the interest clock stop the second you take the money out of the bank? Yep. So what do a lot of us do to eliminate or reduce that? Let's say you got a really good bank, okay? A really good savings account that's paying you 4%. Now, I know none of you probably have a 4% savings account, but let's just say you did. You would never want that bank account to go away, right? You'd never want them to change that rate. You'd always want to get 4%. You'd think you found something really good. So what a lot of people used to do, not so much anymore, is if they had a really high interest savings account or some place where they were earning guaranteed interest at a higher rate, they would go out and they would borrow from a line of credit or someplace like maybe a credit card, an intro credit card with like a 0% or 3% intro rate. You know those things, right? So let's say you're making 4 in your bank account, but you could borrow money from a line of credit at 3. How many of you would do that, right? You're earning 4 and borrowing at 3. How many of you would take advantage of that? It should be all of you. It should be 100% of you, because you're making a spread. You're making 4% when able to borrow at 3. That would be freaking amazing. People would line up at that bank. People would be like, wait, Chris, you just found a bank that pays 4% and you borrow at 3? And I'm just making numbers up here, but everybody would want to know Chris Naugle's bank. Where is that bank? Why? Well, because they'd get to make a spread. They would. They'd love it. I'm making more than I'm paying to borrow the money. I'm making money for using the money. Hell, I'm going out and partying like it's 1999 with the money, and I'm still earning a spread. Folks, think about that. Hey, if you're still letting the banks control your financial future, I think it's time to rethink the game. My hand-picked team is hosting a powerful 3-day virtual training where you're gonna learn how to build a financial system that puts you in control, not the banks, not Wall Street, you. This event is designed to teach you how to recapture the money you're currently giving away to all your lenders and how to create uninterrupted cash flow in your life. And it's going to structure your finances the same way the wealthiest families have for generations. General admission gives you full access, but VIP gives you the recordings, the bonus sessions, and the legacy level tools, including the same structure used by the Rockefellers. Now, seats are limited, so grab your ticket right now and start learning the blueprint to take back control of your money for good. Like, that is everything we talk about every single day that we teach the infinite banking concept, because that's all we're doing. We're flipping the script. We're becoming the bank. We're taking control of our money. And we're putting our money in a policy where we earn a higher rate, a higher guaranteed interest rate and dividend, okay, we call that dividend crediting rate, than what the cost to borrow is. And we prove this mathematically. Now, that might not be the case the first 2 years because there is a capitalization period. You got to put the money in the policy and capitalize the policy. So the first 2 years, 3 years, whatever it is for your policy, you might not have that happen. But then from that efficiency point, we'll call that for all intents and purposes today, the third year. Now, everybody's situation is going to be different. A little bit of compliance disclaimer. Everybody's situation is going to be different. Everybody's numbers are going to be different. I'm just giving you generalizations of how this works, okay? So if you were earning more and paying less to use the money, well, you would probably find a place for that money to go where you could earn money a second time, because now you're making money twice on every single dollar. That's pretty cool. Now, if that were the case, here's what most of you would do. You'd go out, you'd set up that bank account. You'd put as much money as you could. But let's say those bank accounts, those really good banks that you could earn 4 and pay 3, hypothetically, okay? Let's just say it had a cap of $50,000. That's all you could put in it. That would suck. All of you would max that sucker out as quick as possible. And then you would be saying, hey, can I open another one of those bank accounts? And the bank said, hey, we don't always offer this, but because you're a preferred VIP client, yeah, we'll allow you to open another bank account. Matter of fact, Mr. Client, you can open as many of these bank accounts you want, but everyone has a cap of $50,000. Well, what you would do is you would literally go in, take probably most of you would take almost 100% of your paycheck, net paycheck, you'd put it in that bank account. And then what you'd do is to do the things you want, like buy cars, take vacations, you'd go in and you'd borrow money. Because let's say every one of those bank accounts had like a open line up to the amount you had in the bank that you could use. You'd go and use that money and you'd be making 1%, which is more, just so you all know, than most all of you are making on your bank accounts. Because here's the average right here on the board. The average bank account in this country, the average bank account interest rate in this country is 0.42%. They call that 42 basis points, not even 1%. But yet in this magic account that we're hypothetically talking about, where you earn 4 and pay 3 to use the money, like you'd be making 1%, which is more than the average. How freaking cool would that be? Now, let me just double check. I gave you all that really fast. Did everybody catch everything I said? Stephen, is there anybody confused? Did that all make sense? I'm just building up to a narrative. That made sense?
Yeah, looking good.
Yeah,
Does anyone have any questions about what I just said? Did that not make sense to anybody? Is there anybody on here that would be like, nope, I wouldn't do that, Chris. I wouldn't put money in to earn 4 and pay 3 to use my money. Nope, I wouldn't do that. Because then I would say,
Chris, I think there was one question that maybe we should address now, and Ernestine was asking a good question. Said, "Hey, I thought I heard Lafayette was at a 6.75% interest rate," and I was just kind of sharing the economic benefit of paying loans back. So maybe just touch on that
well,
briefly.
before that, I'm going to get to that. We'll just show you the
Okay.
math on that. But hold on. So people are kind of hearing everything I'm saying and getting a little too excited. Like, where is there a 50,000 limit? Folks, I said hypothetically. I'm just building a narrative. I'm just making this stuff up. But it would be cool, right? Right? Paul, that would be pretty cool. I know that would suck. Why is there a $50,000 limit? I don't know. I'm making this shit up. I'm just kind of riffing here, just try to get you all to understand something that, yeah, if that was available, if there really was a bank where I could earn 4 and pay 3 to use my money, even if there was a $50,000 limit, I'd continue to just keep opening those suckers. Right or right? So forget about the semantics. That doesn't exist in banking world. It doesn't exist. There is no bank that I know of, and this is in fact, you can look at ChatGPT, but I don't think there's a bank out there that will pay you 4 and let you borrow at 3. The bank would go out of business. That's all I was trying to do. Just trying to build a narrative. But you see, here's what would happen. If that perfect bank worked, if there was really a thing, there'd be many of you on here that over the next 5 years, you would put all your money in there. You'd max out one of them at 50, then the next one at 50, and the next one at 50, and the next one at 50. And if all of them came with one of those magic lines of credit that you could borrow from up to your limit of 50,000 or whatever amount you have in there, you would have all sorts of these lines of credit, which means if you were Craig Yenny, you'd have a spreadsheet for each one of them, which if you had 10 accounts, 15 accounts, 20 accounts, for some of you higher net worth folks, that'd get complicated, wouldn't it? You'd have all sorts of spreadsheets. You'd have to keep track of interest on each one of those lines of credit attached to your bank account. You'd have a lot of tracking to do. Now, some of you would be like, nope, my bookkeeper would do it. Good for you, but your bookkeeper would have a lot of tracking. Some of you are like, nope, my QuickBooks with AI would do it. Okay, well then QuickBooks would have a lot and errors would be made. But listen, everything I just told you, the only reason I said that, forget that I even said that there was a bank that exists, because I'm just being honest, there is not. But there is insurance companies where that exists. Maybe not those exact numbers. Actually, the numbers are slightly better. So depending on what company we look at, Mass Mutual 6.6, Lafayette, correct me if I'm wrong, did they just go up to 5.9? Is that what it was? Your 5.9 dividend crediting rate,
Yep.
And Guardian's over 6, New York Life's over 6. I'm just trying to kind of go through my memory, but they're all pretty good, right? And most of those companies, we'll get to the Lafayette Life at the 6 point something% interest rate on the loan, because someone had called that out. They're like, wait a second, Chris, Lafayette Life pays 5.9% dividend crediting rate. And the dividend crediting rate really doesn't matter. We'll get into the numbers in a second, but I got to first drive home the narrative of why I'm here teaching you something today. It has nothing to do with numbers or semantics or things. It's just understanding the concept of why do we do this? Why do we use insurance companies and not banks? Okay. Why would I ever open a specially designed whole life? Well, you all answered that. Every one of you on here answered exactly why you would do that. Because if you had a place where you could earn more than you could borrow from, you would put your money there. No ifs, no ands, and no buts about it. And then to sweeten the pot, let's just say you were able to earn interest on that account in a tax-free environment, to which Whole life insurance, if built properly, does grow tax-free. So now we've got a higher guaranteed interest rate. We've got dividends that get us right around 6% gross, and that's earning tax-free. Shoot, that's like a bank account. You can figure the after-tax equivalent yield on a calculator, but that'd be like a bank account having to earn way more than 6%. Because if you're earning 6 tax-free and you're earning 6% in a taxed account, after taxes, you didn't earn 6%. You earned a lot less. But when it was tax-free, you earned what you earned. Okay? Everybody understands that. And then the other equation is, why would we use the whole life? Well, if you get sued, someone slips and falls, okay? It gets icy around here. Someone slips and falls and sues you, goes in, looks at all your accounts, which they will. The attorneys will. They'll look at your accounts. They'll look at all your bank accounts. And you know what they'll do? They'll start, you ever see people when they get real excited, or like a dog when it gets excited, it froths at the mouth? That's what the attorney will do. They'll get that froth around its lips because it's excited. Its tail, the attorney's tail starts wagging. You can't see the tail, but just envision that tail's just going crazy. And that's because the attorney just found the hidden grail, your traditional bank accounts, which have no protections and is like low-hanging fruit. Matter of fact, the apples have already fallen off the tree. They're just going to go pick them up and put them in the bushel. But then over here, the attorney sees all this money in these cash value life insurance policies, whole life policies, to which the attorney is not frothing, the tail is not wagging, the tail is tucked between their leg, and they are whimpering, running away. Because that money is protected against judgments and liens in most states. And the attorneys know this. That money, no matter how much you have in those whole life policies, is generally protected from judges and liens, or from judgments and liens. And not only that, the inevitable, the day we get to go home, the day we get to go to heaven, that is the day we die. We're all going to die. So the whole life policy, which we've already proven pays a higher guaranteed interest rate, has dividends, grows tax-free, protected against judgments and liens, plus has a death benefit that is paid tax-free to our beneficiaries the day we die. It is self-completing. Your bank account is not self-completing. Matter of fact, your bank account goes through probate. Oh yeah, don't know what that is? Look it up. You ever have anyone die in your family and had to learn about probate? Once you go through that, you're like, I'm never doing that again. Well, the whole life policies are protected against that. There's no probate. It goes direct to the beneficiary. So listen, all I did in the first 20 minutes, or actually 15 minutes here, is build a narrative as to why we would ever want to put money into a specially designed and engineered whole life policy. Now we can get to the problem. Because it's so good, once you start doing it, now I know a whole bunch of the 130 some people on here have already started with us, because I know that for a fact. We have thousands upon thousands of clients, which means just by sheer nature of the law of numbers, many of you are clients already. You've started policies, but here's the funny thing. Very few of you on here have only one policy. So once you get one, why would you need more? Pause. Go back to that example I gave earlier. Remember the bank account, the hypothetical, the magical, the fictitious bank account. I want to preface that. The page of 4 and allowed you to borrow at 3% from a line of credit, but it had a cap of 50,000. But eventually, over years, you had many of these accounts, and it got complicated. It got to be a burden. It got to be lots of spreadsheets. Well, the same thing happens when you do this with policies. You got one policy. You're borrowing money from the policy to buy cars, to pay off debt, to invest in real estate, to do private lending on privatemoneyclub.com. And then you max that one out. Why? Because, well, it had a cap. Because when you set that policy up, you said, hey, Chris, Craig, Steven, one of our mentors, I want to have a policy and I want to put $1,000 a month away in it. Great. We're going to build your policy, specially design and engineer your policy for the most efficient policy design at $1,000 a month, $12,000 a year. But then after that first year, maybe second year, you're looking at it and you're like, oh man, I got to raise at work. I got these bonuses. I got these rentals, which are producing revenue. So turoing my cars. You got all this extra income and you're like, I want to put $2,000 a month way into that policy. And you call us and you say, hey, Chris, great news. I'm making more money. I want to put an extra $1,000 a month into that policy you set me up. I love it. And I tell you, sorry, we can't do that. Why not? Because if we put an extra $1,000 in, we're going to mech the policy. The IRS isn't going to look at this thing as life insurance anymore. They're going to look at it as an investment. And they're going to want to tax you every year. You don't want that, do you, Mr. Client? No, I don't want that. Great. So here's the solution. We're going to open up another account. We're going to open a second policy. And then in time, what happens is the person opens several accounts, then opens a couple on their children, and then they do a couple on their spouse and maybe their key employees. And eventually, before you know it, you're like me, you got 14 policies. And when you got 14 policies, you got 14 different things to track. You got to track premium deposits into all 14. You got to track loans from all 14. You got to track loan repayments to all 14. It becomes a burden, doesn't it? A big burden. Well, this is where the story starts for today, because today what we're going to talk about CV lines of credit, cash value lines of credit. Okay, and I have a guest from Boosie Bank, Brandon, coming on. If he's here, we got to promote him up to panelist. So, Stephen, if you can be on that. But we're going to talk about cash value lines of credit. Now, here's the thing. Sometimes I hate talking about this because it's kind of like we're creating our own private banking system. We don't need banks anymore. We don't want banks. We paid all the banks off. We got rid of all the banks. It's just us. It's our bank. It's our private bank. And now, Chris, you want me to go and get in bed with a bank again? Well, sometimes you just got to look at things in life as, is the juice worth the squeeze? That's a Brent Kessler line. Is the juice worth the squeeze? Well, I got 14 policies. That's a lot to track. A lot of spreadsheets. And where it became burdensome for me was after I had about 5. Because I was tracking 5. I had loans out. I couldn't remember how much the loans. I couldn't remember how much I paid back. I'd have to go online all the time and look and chart it and track it. So somebody once, I don't remember who it was, told me about, well, Chris, why don't you get a line of credit on your policy? I'm like, what does that do? He says, well, it'll take all of your policies and it'll basically give you one pool of money where money can come out of and go into. One central point of access. And then you'll have online dashboards for that. I'm like, okay, so all my 14 policies look like one from an access standpoint. Right. And then this person told me, okay, yeah, but also you might be able to get an extra 5% access to your money. Because see, one problem with the insurance companies, you can look at this as a good or bad, okay, is if you had $100,000 in cash value in your policy today, who can tell me how much money most insurance companies would allow you to borrow? Can anyone tell me? You got $100,000 in cash value inside your policy. You want to take a loan. What's the max amount most insurance carriers will allow you to take of the 100? Put it in the chat. It's usually about 90%. Now, I'm not saying 95 is wrong. 80 is definitely too low. But 95, maybe there's a carrier out there. But I will tell you, most of them are 90%. And that isn't to hurt you. It's the insurance company trying to, sometimes in certain cases, protect you. They're trying to keep some money in the policy so that if something happened, you went on a trip to Africa, you forgot to make your premium payment, you got some money there that can APL and pay the policy premium. It's like an automatic protection for your policy not to lapse in the event of something happening. So that's actually smart, but that's a downside to some people because some people are like, I want more access to my money. See, when I put 100,000 in a traditional bank, I could take 100,000 out of the traditional bank, to which I'll call your bluff. Try it, is what I'll tell you to do. Great. It'll take you a few days, some paperwork, some questions, but nonetheless, maybe you'd be able to get it. So let's pretend you could. So the CV line of credit, the cash value line of credit, what that does is it gives you access to more money. In some cases, it's 95. I'll have Brandon kind of go into some specifics on that, but we'll call that 95. That's a 5% delta. That's 5% more you have access to. That could be a big deal to some people. Some people have millions of dollars in cash value in these policies. 5% of $1 million is quite a bit of money. But the real thing that really caught my attention was the ease of access. The consolidation of all my policies into one central place where I have access to that money. Now, from there, what we do all the time is, and Brandon will tell you, we go in, Brandon will do a private lending deal. There's 2 Brandons, so I don't want to confuse it. Brandon at PMC Wealth, okay? PMC Wealth, the RIA. Brandon will go in and work with Brandon from Boosie, who will be on in just a second, and tell him, hey, listen, we got a private lending deal. We need to do this. Brandon will tell Brandon, it's the Brandon show. We'll tell Brandon, hey, get Chris to sign these things. Here's what we need, blah, blah, blah. I do that, and then, whoa, money goes right off. Wires right to the private lending deal or to the car purchase or to whatever it is I want to do. And then what I do is I just did all my math to figure out, hey, I just borrowed money to buy this new car. The payment on that would be $1,200. I'm going to make $1,200 payments back to my CV line of credit, my Boosie CV line of credit, to which I do, which then reduces the principal, which means I'm paying less in interest because of APRs and how we calculate math. And that's a pretty cool thing. So to the person that asked earlier about Lafayette Life, Lafayette pays 5.9 dividend crediting rate and charges, what are they charging now for the loan interest rate? It varies depending on contract, but
For the newer contract, 6.75.
so 6.75. So now wouldn't that seem wrong to get, you're earning 5.9 and paying 6.75? Is that what you said? 6.75?
Yes.
675. All of you would be like, you're going the wrong way, Chris. That isn't 4 and 3. But you know what? When you see the numbers, which we will show you today, we'll show you using the vault. It doesn't matter. Okay? From the surface, you're saying, oh, that makes, I wouldn't do that. But when you see the numbers, it doesn't matter. But you see, when we look at the CV line of credit, the same thing is true. Okay? So whatever your CV line of credit charges you in interest, it's probably going to be more than what you're earning in the policy, which is most people were going to say bad. But you know what? We almost are in control of that. If we drive the principal down and our money is still growing, which it is, because using a CV line of credit, your cash value is all intact in the policy, earning 5.9, compounding up. But if you're doing the right thing and you're paying down the CV line of credit, you're driving the APR down. And it won't take you long. We'll show you. I'll show you today. It won't take you long to get on the right side of that where you are making the spread. So I'm going to just pause there. Stephen, Craig, does anyone have any questions about what I just went over before I introduce Brandon and have him explain a little bit about Boosie? And I'm just going to go rapid fire with him. But is there anything I missed there, or things I need to clarify?
I don't think so. I think I've been trying to hit them, and so I think we're good. Unless you see anything, Steven.
Oh, looking good over here. I don't see any Q&A. Guys, try and keep the questions in Q&A. We'll answer all of them in the chat box. Sometimes it gets flying and we don't want to miss it for you. So
Awesome.
rock on.
All right, Brandon from Boosie Bank, welcome to the show.
Chris, how are you?
Good, man. Very good. So I was just kind of building up a narrative here. And really what I was trying to say, and I don't know how much you heard there, Brandon, but I was saying, if you could put money in a bank account at 4 and borrow at 3, everybody would line up at that bank. So eventually the bank would put limits on how much they could put into the account of 50 or whatever thousand. So then people would just go out and open multiple bank accounts to max them out. And they just keep doing that because why wouldn't you? That's such a good deal. And I said, that's where we get in trouble with the infinite banking concept is we open multiple policies. Now we got all these tracking and things just get loose. So that was the biggest reason I landed with CV lines of credit, was just ease of access. I wanted one central place that consolidated all of my policies into one operational place. Made bookkeeping easy. My bookkeeper and CFO loved it. I love it because I just go on. I know exactly how much money I have out. I know exactly how much interest I'm paying, and I know all my metrics. So tell me a little bit about yourself, Boosie Bank, and some of the things that I didn't talk about, which are features of the cash value lines of credit.
Absolutely. Thanks for the overview. Great information. I've been able to be on since the beginning. Myself, I'm a 21-year financial professional, most of that in the banking world. However, I did spend a 3-year window in the insurance world. Loved the work and just was in the wrong phase of life and landed back in banking doing cash value lending, oddly enough, and have found it to be a great joy. I have been with Busey now. We were acquired. We were previously M&M Bank. Busey acquired us. They were our largest participant bank. And so the combined banking world, there are 9 years now that we've been working in this space. Busey has been around since 1868, a long time player in the banking world. Not the bank you were talking about that's going to give you 4% and loan at 3%. But 23 years in the cash value lending space. We refer to it. So if I say life equity lending today, we refer to our product, and it's been trademarked as the LELOC, life equity line of credit. And so that cash value loan, which is our LELOC product, we've been doing for over 23 years, have over $1 billion in the portfolio, and then have a team of 10 located in the Oak Brook, Illinois area. Our world has really expanded greatly over the last 5 years. I remember back in 2018 when I made the call to folks like yourself in the Be Your Own Bank space that I literally got laughed off the phone. And then it was just a couple years later, the phone calls began to come in. Rates began to be very positive on the arbitrage side, which triggered a lot of conversation. But then to your point, I know we'll dive into it more as you get more and more policies, and it becomes more and more complex to manage those loans in the model that you're building. It makes a lot of sense to bring it into one place.
I love that. Now, earlier, I was mentioning a little bit about having access to more money than what the insurance company will give it. Now, you see it from a different side. You see it from afar, where we're kind of in the trenches with the carriers. Most of the carriers I know will allow you to borrow 90% of your cash value. But with the lines of credit, with the CV line of credit, sometimes that can be more. Can you talk about that?
Absolutely. So, our general rule of thumb is 95% of the net cash surrender value. So we will, if there's already policy loans out there, we include that in that overall number of what we look at. So 95% is our general rule of thumb. With some of the UL chassis that we do lend on, just being an open and transparent in our product overview, because our primary is the whole life side and typical whole life, but we do work with the standard universal, the variable universal, the index universal with different carriers. And
Hey,
so
Brandon, I don't mean to pause you real quick. I just want to point something out because I'm not a fan of IULs, and any
yeah,
chance I get, I like to, swing for the fences on this one. So can I use this opportunity to just beat up on IULs just a bit?
absolutely.
Okay, so in an IUL, there's always the cash value, okay, the accumulated cash value, and then there's the surrender value. Can you just tell this audience what you will look from a bank standpoint? Will you lend on the cash value, the accumulated cash value, or the surrender value?
So both with the IUL and the VUL, we're going to look at the actual surrender value.
Oh, darn. Hmm. Okay.
So
So that's going to probably be significantly less in the early years than the accumulation value. But you guys won't look at that
absolutely.
accumulation value, even though the agent sells these things on the accumulation value, but you guys won't lend on that.
Correct.
Okay. All right. Sorry, I didn't mean to pause, but like I said, anytime I get a chance to take a nice, good swift between the legs of those IULs, I do. So carry on.
Absolutely. So yeah, 95%, on the net cash surrender value, able to do that from, and generally a turnaround of 15 to 20 business days. Obviously, it always flexes with the carrier, getting the assignment in place, depending on the number of policies that we're adding onto the line of credit. But the good news is we're able to encapsulate outstanding policy loans. So in the event that there's not already loans, but the need is quicker than 15 or 20 business days, the loan goes to the policy. Part of our process, we pay it off. So very very simple in the process for us to pay that loan back off and it roll over to the line of credit.
Okay, so now how often do people have to make payments on the CV line of credit? So, like with the policy, if we take a loan from the policy, we don't have to pay any interest back to that policy until our policy anniversary, which could be 12 months from the day we take loan. With Boosie and CV lines of credit, or you use them LELOC, so from the LELOCs, how often is an interest payment due?
So we do quarterly interest. It is a simple interest calculation, same as it is within the policy, but there is a quarterly payment requirement. On that, though, the good news is, if necessary, we can capitalize the interest into the available line of credit. So as long as availability is there, we can roll that, and you can make payments as often as you would like. And those interim payments would just be a straight principal reduction. So even if interest rolls quarterly to the principal, but you're making a monthly payment, we're automatically paying it directly to a principal reduction, so that way it's saving you on the interest cost.
Oh, that's why. So I always wondered that. Actually, just explain something, because you've seen mine. You know how I do mine. Every month I make a payment to Boosie Bank. That's my recaptured money, and we increase it all the time. And as I do that, I always see the math like on the register, and I was always wondering, well, I wonder why they calculate it that way. But you just explained that. So actually, that's a really positive thing for me, because I'm paying principal down, which means Boosie's charging me interest on the lower balance all the time by me doing it that way. So it does make sense to be an honest banker, folks. Okay, let's see. What else with the CV lines of credit? Like, what are some other advantages? Now, I know right now, it was kind of a bad place to be. I wrote it out because I understood the mathematics of APR and paying down the loan and how it really worked. But when most people look at this, especially now, or in the last year, a couple of years actually now, with the high interest rates, people are like, wait a second, Boosie's charging whatever 6-7%, and I'm only earning 5.9. It doesn't make sense for me to do that. I'm gonna borrow from the carrier, which is cheaper. But right now, because the Fed's been dropping rates, and because banks trend to prime rates and Fed rates, what you're seeing is almost a leveling effect. So now you guys are almost where the carriers are from a borrowing standpoint. And from Lafayette Life standpoint, you're actually less because Lafayette's 6.75. You guys are, depending on credit score and several other things, lower than that. Am I correct in saying that?
Absolutely. So yeah, rate in the right environment and with the right spread is one of the absolute advantages to the line of credit. I'll kind of hit back from the top. I think there's a couple advantages that really stand out in comparison to a policy loan. One, you've got a line of credit, which is operating, functioning, live and real versus a loan that is just a fixed number out there. The speed of borrowing, once the line is established, a couple ways that you have access to funds, and you talked about it earlier, wire that we can send out on your behalf, ACH, which now is same day and has no fees to it. And then we do provide a checkbook to our clients. So it functions like a checking account, but it's not a checking account. So no debit card or anything to that, but they do have checks and the ability to write the check out of it. The combined value of multiple policies across multiple carrier channels, which I think is extremely advantageous to most people, because in the scope of their building their portfolio, it may make sense with a different carrier. And so within the approved carrier channels that we work with today, which is about 12 carriers, we're able to combine those into one line of credit. The avoidance of potential policy restrictions. Some carriers with policy loans have restrictions. Some carriers, based on the way they credit, of course, the dividend is altered or adjusted because of the outstanding loan. With us, everything stays intact as it was designed from the very beginning. And then I think a huge advantage that is often overlooked is the ability or the potential ability. I'm not the tax guy, so I don't want to give you any certainty, but the tax deductibility of the interest when used for business purpose. And so, we talk about rate a lot, and oftentimes our rate may be a little bit higher than where the carrier is. And some would say, well, it doesn't make a whole lot of sense. In your world, and in a lot of the be your own banking world, we have found that when you have multiple policies, even if the rate's a little higher, it's made sense to consolidate everything in one place. But if you're able to reduce that tax liability, interest off the tax liability, and deduct it on your returns, then the overall effective rate of borrowing comes down, oftentimes much lower than the carrier, depending on your tax bracket. So when it comes to rates, rates are what they are. The difference with a carrier is they set a rate once a year, and that's the rate for the next year until it's evaluated, and then they may change it. It may change, as it was mentioned a little bit earlier, on new contracts have different policy rates than some old contracts. Some are higher, some are lower. For us, we're tied to Prime. Prime has not been very, very advantageous over the last couple of years. However, we've been strategic in our world to maintain portfolio and to do what we could to make it work for the borrower and to bring the arbitrage closer. As we see rates coming down as they are right now, the environment gets even better to where I think in most cases, especially on lines 250,000 plus, that we're able to see rates that are often at or below the carrier rates, and it creates a great positive arbitrage on the rate side.
I love that. Another nice thing that I've loved about Boosie compared to the other ones that I've used is when I get my policy statement, when I get, every year I get a policy statement and my cash value, the beauty about whole life insurance, and that's all we do. We don't monkey with those IUL nonsense things. So in a whole life policy, every year you're guaranteed to have more than you had the year before. So every year I get a raise. And then I want to use that money. I want to basically use it to expand my capacity. So all I do is I send those statements over to you guys, and you guys will, and I try to consolidate a couple of them because I have 14 of these things, and I try to give you, several at a time. But then can you explain the process of increasing my line of credit, how simple that is?
So, we've made it much more simple over the last couple years. In the past, we did have to collect, even if one policy had increased a significant amount to increase the overall line, we had to get all 14 policy reports and view them all. We still do that at times. However, the good news is on the front end, the way that we write our lines of credit, not necessarily standard across the industry, we actually take the initial or current year's cash value number, and then we take a buffer, taking the premium of the next 5 years, and we build that into the initial approval amount. We put a freeze on the variance there, and then as you pay premiums every 3 months, 6 months, a year, depending on how your structured premiums are, we get that policy report. We can then unlock that additional capital for your availability in the line of credit. So no signatures needed. Everything's on a green note. Nothing needed on your end. We're able to simply unlock on our side. You get a note that your credit limit has been increased, and we go from there.
Yeah, I found it to be very easy with you guys to increase my lines. And, anytime I want, when I have a policy, I often, because policies come in at different times, I often have one policy that'll come in, it goes up 20, 30 grand. I mean, I want that access. So I just send that one in, and it's been super easy to do that. Now, how about for people that are just getting started? What are some of the things that they would need to know? Because not everybody's going to fit this. I had some person on here who said, I only have one policy. Does that make sense? What are some of the things they have to go through to get approved for the line of credit that may be hurdles they got to get over or obstacles?
So, I mean, I think, everybody with a whole life policy is an ideal candidate. Couple factors going on because we've got them from one policy up to, I think our largest is 80 something policies. Extremely large portfolio, got trust policies, business policies, and the personal policies all in one and have that combined into one line of credit. Just getting started, there's a couple for us at Busey Bank. It's the minimum borrowing is 75,000. So you got to have at least, the call it 85,000, 86,000 to get to the 75 at 95% loan to value. And that's where we start. That's just more of a compliance factor on our side, keeps us in check and in line for audits and so forth. From there, whether it's one policy or a number of policies, it's just looking at what the needs are, what your situation is. Every situation is unique, and I get the question all the time, what's the ideal client look like? It really goes back to my first statement there. If you own whole life insurance, you're an ideal client.
I love that. A couple other things. I just kind of want to go back to the beginning. You hit some things that I often don't talk about. So if you've got a good CPA, folks, and you go to your CPA with your policy loans and you say, hey, listen, this year the insurance company charged me $2,000 in interest on the policy loan. Most CPAs, not all, consult with your CPA. I'm not giving you tax advice, but most will not allow you to write that interest off. Okay. It's just generally they just don't. I don't know the specifics because I'm not a CPA, but I know my CPA pushed back on that. But my line of credit with Busey is a commercial line of credit. Okay. So when I borrow from Busey and I pay interest to Busey, my CPA is like, hey, do you got those Busey statements that shows the interest you paid them? Which I don't really need to look because Busey sends me a statement at the end of the year showing the total interest I pay. Loves that. He's like, yep, right off. So if I paid Busey, let's just say, I don't know what my average is over the last couple of years, 6.5, let's just use 6.5% interest would be the stated rate. Now, every year I didn't actually pay 6.5 on the total because I've been paying it down, but that's APR. We'll talk about that with the vault in a second when we get into the second phase of today. But now all of a sudden I get to write off that interest. So doesn't that help me? Should that be factored? Like, Brandon, how would you go about, like, just the average person? Like, is there any kind of a calculation they could use? I know ChatGPT probably could do it, but like, how would you figure that out? Like, what savings does the tax deductibility of the interest give you? Like, do you know how to answer that?
It's a broad answer that doesn't have a specific. I mean, because it's based on your tax bracket. What tax bracket do you land in terms of your effective tax rate? Because of course, how it tiers up based on your earnings. Where is your effective rate at the end of the year? What does that look like? And then based on the interest, how much of that are you able to deduct? Then you filter that back into the interest that you paid and do the math on it, and you can subtract it out of let's just say 6.5 on an average in your case. Take that off of that, and let's say it brings it down to 5.2. Just depending on the numbers, there's a large spread there when you're able to deduct, and especially as the lines get larger for our larger clients, the tax deductibility becomes a huge rate arbitrage in spreading the effective rate of borrowing.
Perfect. Craig and Stephen, you guys have been fielding all the questions coming in, and I know we've been going rapid fire with this. Is there any questions on there that you might be able to kind of highlight that you think we need to hit while we've got Brandon's time?
Yeah, definitely. A couple. Eduardo was just asking, can you give a little more detail about the approval process? So, what is entailed, like credit checks, FICO score, income asset, documents, anything like that?
So great question. Our process is fairly simple. The application's short. We generally do it through our online portal. It takes you 3 to 5 minutes. It's basic personal information, a short financial statement of assets, liabilities, income, and expense, just rounded numbers, and then your insurance information. We get the policy summary or policy detail reports that has all of the pertinent policy information on that 1 or 2 page that Penn, Lafayette, the likes are able to generate for you, or you're able to generate in the portal. From the backside underwriting, I've been doing this almost 9 years. I've had less than 5 declines. One might have been credit. The others were all tax liens or judgments. So it's not very often that we get a decline. One, because we're securing cash with insurance companies that are much stronger financially than even Busey Bank is. So, we're in a good position from a lending side. What will affect you is if debt to income is lopsided, if credit score is low, then we're going to have some questions. We're going to talk through that and make sure that from a borrowing perspective that you have the capacity to make that quarterly payment. But pretty simplified compared to most banking loans.
All right, cool. Very
Any
good.
other
I will
ones?
add to that. I will add to that because it's always important. So we do pull a credit inquiry with TransUnion on the front end, but future increases that do require documents are only a soft pull after that. So, and then we do not report to the credit bureaus, so it does not reflect on your credit report as a debt service, would not affect your future debt to income numbers, which is very important.
That's huge. Thank you for bringing that up. And I didn't even know that. I thought for sure you guys were reporting to the credit bureau, but you don't.
No, no, sir.
Okay, so that makes that very much like the carrier because nobody knows about the loans with the carrier because it's not reported. So you keep that, what's that word? And help me out with that. When you don't want anyone to know what it is, what's that called? Anonymity?
Yeah, I mean, we just keep it suppressed and or anonymity. I mean, yeah, it'd be either way. So it's just we're not reporting. The only time it would ever be reported to credit bureau is if it was a delinquent loan and we had to call it. And although the call is only from the carrier, we take a policy loan, then we're able to then report it to the credit bureau.
Yeah. So just to kind of sum this up, and I'm going to move to the next part, Brandon, thank you so much for your time. But this is an important thing I want to point out is some of you would be thinking about this and you'd be kind of weighing out, because it's always just, is the juice worth the squeeze? Weighing out the pros and the cons. Okay, I get 95% versus 90. I get to, look at all my policies as one. So that's convenience factor. You got, the fact that it doesn't get reported, lots of pros and cons here. But the one thing that a lot of you are probably looking at is, yeah, but now I've got a quarterly interest payment that I have to make, where with the policy, I don't have an interest payment but once a year. But, I'm going to tell you something, and this is probably not for all of you, but for some of you, like, you need to hear this, and it might be hard, but that's a good thing because what it does is it enforces discipline. I will tell you, having thousands of people that we help with the infinite banking, one of the biggest problems, one of the big things that, really pisses me off is when we spend all this time, this energy, 1,300 YouTube videos teaching you the proper way to be your own bank. But then we got a lot of clients that they're very good at taking loans out of the policies. And they're very good at buying the things with the loans or investing in the things with the loans. But then we find out that laziness or something happens and they forget to recapture the money back into the policy. So they're literally stealing from their bank. This happens all the time, folks. Drives me nuts. It's the reason for a lot of the features in the vault, to prevent this. But this is where I say the CV line of credit, Busey Bank, having quarterly payments enforces discipline for you to be an honest banker, for you to pay yourself back and pay yourself back with interest because you have to. So you can look at that as a bad thing. I see that as a good thing for many people because I think a lot of people need that discipline. They need to be forced because listen, in the normal world, when you take a car loan, you make monthly payments to the bank. And if you don't, Repo Man's coming anytime between 6 p.m. at night and 2 a.m. in the morning and your car is gone. So you understand the consequences. But when it comes to the policy loans, there's no real consequence. So that's a nice feature in my opinion. I don't know how all of you see that, but I really, truly like that because that discipline that you need to build. And then eventually it just becomes the norm because once you start doing it and you see that every payment you put back in the policy or every payment you put back into CV line of credit creates more liquidity for you. Because if you're making a principal payment to Busey like I do every month, like I got that money's there. It's not like I lose that money. It's not like that money's not accessible. It's literally almost dollar for dollar there. Yes, they take their interest from it, but it's still, I get that principal part. So once you see that, it simplifies your life. It simplifies the flow. You get into the flow and you get used to doing it that way. So I like that. But faster funding, easier access, consolidation, and enforced discipline. Those are all the main reasons I can see. Do you think there's anything else that we missed here, Brandon?
I think you covered it well.
Awesome. Well, Brandon, if people want to get a hold of Busey and want to get a hold of yourself, how do they go about doing that to set up or talk about setting up their CV lines of credit?
I mean, easiest way is connect through email. We do have a landing page at buseybank.com. but or at busey.com. I apologize, but you can also email me direct, brandon.miller@busey.com. And I would love to have a conversation, see how we can help you as we've helped so many others within the network and been a part of helping you build your own bank.
Awesome. Thanks so much for your time, Brandon.
Hey,
Really appreciate it.
Chris, one quick thing.
Oh,
There's
sure.
one more question we didn't get through, I think, Brandon, and you can help us with. So
Great.
earlier you were talking about the protections that we have inside of life insurance contracts. And of course, all of those are state-based. Each state has different protections for cash value from creditors and predators. So the question was asked, if you do a cash value line of credit, does that have any ramifications for those protections against that cash value? Does that open up a door where there may be some, freer access to that cash value from somebody? Let's say someone's suing you or bankruptcy or those types of things.
I mean, to my knowledge, no, it's still protected under the insurance policy, the line of credit, again, because it's not reported out there other than an assignment on the policy showing to Busey Bank. But not being on the legal side, I don't want to answer that with full legal response or accountability. But we've not run into that anywhere in the past.
Okay.
And I think that's the
All
right
right.
way to
Thank
answer
you.
it, Brandon, because like the money never left the policy. So if all your cash value is in the policy, you're just leveraging it and using the bank in the line of credit. So if the money's still in the policy, then they'd still have to go to the source, and that's where it's protected, as long as you're in one of the protected states. Anything else, Craig, Stephen, with questions, or should we move on?
I think the only other thing I recall from questions that maybe we didn't answer, and I was waiting for clarification from the person, but I think they were asking, does Busey Bank do first lien HELOCs?
Yeah, I mean, so we do have a wide footprint now. We're not. I would say your local bank is still a better HELOC partner. We don't have. I mean, we don't have a program really to outside of this product and our mortgage product that really go our standard mortgage product that really goes nationwide. I mean, we can definitely talk and see what we can do, but I've had the question come up a lot, even in our client base, and generally we just refer them back to their local bank or local credit union, even if somebody they don't have a relationship with, that generally would have a better rate because they're in market, and being in that second position, it's often difficult out of market.
All right, perfect. Well, hey, Chris, I think we got through all the questions.
All
So
right.
thanks, Brandon.
Thank you so much, Brandon. And again, we'll put that link up there. It's Busey.com or Brandon. Sorry, I put it up there wrong. Craig, could you correct my spelling on that? I spelled Brandon without the N. Brandon.miller@Busey.com. So go ahead, set up a time, send him an email, ask questions, and talk to him about, why it might make sense for you. Fantastic. Thanks again, Brandon.
It's Chris.
All right, guys, we're going to continue on here. Now, one thing I want to do here, and Shauna was nice enough to go in and do some, one of the things that we've gotten really good at over here is, we like to fact check things, or I don't want to say fact check. We like to go back into history. I like looking at history. I don't know why. I've just always been that guy saying, okay, if this is what it is today, how long has this been done and how has it been used in the past? So I can kind of look at how somebody else used something similar before I venture down a path that I've never gone down. So one of the things that's really interesting, and I'm going to go back to the early 1900s on this, okay, is in the early 1900s, business owners, and I add to business owners, I'll give you some names, those of Walt Disney, those of Ray Kroc, okay, two business owners that I know for a fact use this. But we're going back early 1900s, business owners collateralized life insurance with banks all the time, okay, because loan features on policies have been around for a long time, but not forever. So prior to the policies being, the whole life, because back then there was no universal life. Just so you all know, prior to, let's just say late 1970s, early 1980s, there was no such thing as universal life, period. IULs are like a freaking toddler. Not even, they're still a baby learning how to crawl. Like that's how new they are. But whole life's been around the whole time. And they couldn't take loans. So what they didn't want to wait on insurance companies, okay? Because, today it's fast, but back then it wasn't. So what they would do is they would go to their bank and they would use the policy as leverage or as collateral to get liquidity. Now, I know that's kind of moot point, but it's just interesting to know that all the way back to the early 1900s, this is how it's been being done by wealthy families, by business owners. Cash value life insurance this is nothing new, folks. So those of you that think, oh, this is some new thing, that must be a scam, blah, 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 blah. Okay, why has it been done for literally almost hundreds of years? I can almost say hundreds of years now, but well over 100 years is an easy way to say it. So let me ask a couple questions here, and then we're going to move on because I want to show you some math. Okay, I think that's a really important thing because we listen to these webinars, and we got a good amount of people, 130 some people on here. We listen to these webinars and we get these ideas in our head, but for some reason, and I'm no different than you, we get numbers stuck in our head. I intentionally planted some numbers earlier. I planted 4% and 3%, which you all love, but then somebody said, the Lafayette story, which is 5.9 and 6.75. And you're like, that's wrong. 6.75 higher than 5.9, bad. 4% higher than 3, good, right? So I gave you those numbers, and I did that intentionally because that's what most people, that's all they know. And they get hung up on that, and they're like, that makes no sense. But you see, when you really start learning math, and you start understanding how math really works, like banking math, like this is what banks do every single day. You start to understand that it isn't, from the surface, isn't what it seems. I did a webinar last week, really fun webinar for Christy Van. And we got to go into something, me and Craig, and we got to talk a story of borrowing at 6 when you're only earning 4. Does that make sense? If I was earning 4% from the bank and I was borrowing at 6, does that make sense? Most people would say no. They would just take the cash out of the bank, buy the car, and be done and not have to deal with that because 6 is higher than 4. But when we do that example, what you find is that, yes, 6 is more than 4, but when it comes down to the math and application, you make more earning 4 than you do when paying 6. We're going to show you that, okay? So everything that we're talking about, I planted the seeds for you to know these things, but let's ask some questions to see how relevant this really is. Out of all of you on here right now, how many have ever taken a loan from your policy? And I don't care what kind of policy. If you've taken a loan from your policy, put I in the chat. Let's see how many people have done this. Terry has. Let's keep that going. How many of you have more than one policy? So how many of you have more than one policy? Write number 2 in the chat. So if you have more than one policy, write the number 2, okay? Look at that, 4, 7. Anyone got more than 80? I just wanted to see if we had that person on the phone. Curious who that is. I think I might know. All right, lastly, would faster, more flexible access to your capital help your business and your family? Put yes or no. And a lot of you might say nothing because you're like, well, I get money fast from the insurance carrier, which you're right. Listen, I'm not here to make the case whether a CV line of credit is good. We don't sell them. We get nothing from them, nothing at all. Like there is no affiliate arrangement there, okay? The reason we bring that on is because sometimes I wish I learned about it earlier. And I'm sure that's the case for many of you, is like, how come this is the first time I'm hearing about this? Well, because a lot of times people don't want you to know about things because they can't benefit from them. I.e., no disrespect, when I was a financial advisor, I assure you, you didn't know about anything that I didn't get paid about or paid from. And that isn't a greed thing. That's what I was trained on. And literally, like, so much so that the broker dealer I used to work for would call some of the things selling away. We were not allowed to recommend or give advice on HSAs. I know back then they were a new thing. We all know what health savings accounts are now, but we weren't allowed. It was like a selling away feature because the broker dealer didn't get paid on it. So they call it selling away. And that was the case for lots of different things we couldn't talk about because it was selling away. So listen, Will Rogers always says the biggest problem isn't what we don't know. He says the biggest problem is what we think we know that just ain't so. So I just figured, since I know about the CV line of credit, whether it makes sense for you or not, whether it fits your narrative or not, doesn't matter. It's nice that you now know about it. So it's another quiver that you have to use if that need ever came up. But they don't teach any of this stuff, Marco, in school. And mark my words, they probably won't unless you live here in Buffalo. I am pushing right now and donating heavily to my daughter's school to build a arts and performing arts center where we're going to do regular financial education for the students, the teachers, and also the parents. And we're going to make that a thing. And hopefully that'll spread amongst private schools, but public education, good luck. So what I wanted to do over here with this board, and then we're going to use the vault. So Craig's got some really unique things, and we're going to get into some of the math behind that 4 and that 6. Can you make more earning 4 and paying 6, and why? In other words, can you make more earning 5.9 at Lafayette when paying 6.75? The answer is absolutely yes, every single day of the week, and we're going to show you that. But I want you to understand the flow, because some of you are new to infinite banking, and I always tell everybody, like I was talking to some snowboarders today who know nothing about infinite banking, and they're like, so tell me about it. And I think it maybe took me a minute and a half for me to explain it to them. And I said, did that make sense? And they said, that made perfect sense. I can't believe I didn't already know about that. I mean, it is simple because all we're doing really, folks, is we're changing one thing, and we're taking the money from our place of savings, whatever your chosen place of savings is. Here, we can call it a bank account, which on average, bank accounts earn 0.42%. Make no two ways about it. That's the nationwide average. Might even be less now. Or 401ks. A lot of you have money in 401ks. Okay, I'm going to do a training on 401ks here one of these Wednesdays, so stay tuned for that. But 401ks, that's just because you're told to put money there. Well, why do you put money in a 401k? Most people's answer is, I don't know, I was told to.
I don't know, my coworker said it was a smart thing to do. I don't know, my wife said to do it. I don't know. It's a bunch of I don't knows.
And some people, the smart ones, are like, well, because I get a match. And then when I ask them back, okay, you got a match. What's your match? I don't know. But some very few ones are like, oh, I get 3% dollar for dollar. Okay, great. How much are you putting into the 401k would be my next question. So remember, let's go through the narrative. I was asking a bunch of questions. The really smart one knew that they were getting a 3% dollar for dollar match. So I asked, how much are you putting into the 401k? Well, I think I'm putting 18% into the 401k. Scratch my head and I think about it and I'm like, wait. They match you 3 and you're putting 18 in. Why are you putting so much in? I don't know. Tax deduction, trying to catch up for retirement, blah, 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 blah. And then after that, I asked them, well, do you have any debts? Oh, yeah, a lot. Credit cards, lines of credit, car loans, student loans, all this stuff. So wait, you're putting money into the 401k on a hope and a pray because somebody told you to, or you don't even know why. And then over here on the other side, like you're not paying your debts down because you're saving for your retirement. You're not going to retire if you got debts. Like the person that goes into retirement mode in debt is not going to live a good retirement. That doesn't surprise anybody, does it? Like you don't go into retirement loaded in debt. You do all understand that makes for a really terrible retirement. So what we often tell people is, all right, well, let's back down the amount you're putting into the 401k. And I know, oh God, you think you're doing yourself a disservice. Let's back that down. Let's change where it goes first, put it over here, protect your family, give you some liquidity, and pay debts down. And then all we do is we take loans from the policies, we invest in real estate, we pay debts down, we buy it, we recycle, recapture the money back over. It's just a circle, folks. This graphic just shows a circle. But I want to show something here. And I haven't shown this in a long time. There's a lot of numbers on this screen. So please don't sit there squinting. Some of you got your magnifying glasses out. Some of you are grabbing your phone, doing that big expand. What's that number in the middle? Let me explain it. All this is this is one of my policies. Okay. It's a policy I put $30,000 a year into. And basically over here, I ran a scenario because I wanted to prove a point back a while ago. And I want to prove that same point to all of you today because this is very important. Because a lot of people still, even after all the videos we do, all the trainings we do, say that this doesn't make sense. But I will promise you something today. I can almost guarantee you something today. By the math, this will always make sense. It's just a matter of when does it make sense. By the math, okay? And if math is our guiding light, if math is the honest one in the room, because, Chris Naugle could lie, Craig could lie, who we got in there? Kathleen could lie, like people lie. Math doesn't. So let's just let math do the teaching is kind of what we've taken the stance on. In an industry, and listen, I have other people in our industry. I've got podcasts with people in the industry we were talking about earlier that just don't agree with what we do. And I always tell them the same damn thing. I said, well, it doesn't matter whether you agree with what I do or don't agree. Math does, right? Who do we want to agree with? Jim, Joe, Johnny, or math? Math. So here's what I did, folks. I did 2 scenarios using my own policy. And all I did is I said, okay, I'm going to put money in 2 different places. I'm going to run a scenario because I want to invest money, and I'm going to save money up to invest. But I'm going to put money in a bank account, and I'm going to use the average return I get on bank accounts nationwide, 0.42%. But I'm going to let this compound, okay? And I'm going to show you the compounding nature, okay? The cumulative compounding returns. And then here's how it works. So I put $30,000 a year into a policy, and I'm going to run it up to 8 years. So if you got the magnifying glass, this little red box is the 8th year that I'm putting money in. In the bank account, I've earned, okay, cumulative 9.25%. So I put in $239,300. I have $261,424 in the 8th year, 9.25% cum. Now, okay, that's the bank account. Some of you are like, well, I get a higher interest rate. As an average, you do not. You might be getting a higher interest rate now because the Fed's been high, but when the Fed goes down, you go down. So that's the average, okay? Just pointing out the obvious. Now let's just say we put that same exact money, the same savings, but we put it into a specially designed whole life. This is my whole life, okay? Started this policy, oh gosh, I don't know, 43 years old, 44 years old. I don't remember how long ago it was. This is how the cash value grows up to the 8th year. And we can look at every single year. So the first year, I got $30,126 in the bank, and I only have $27,534 in my policy. That means the bank account has $2,592 more. What one do you want in the first year? Yeah, I want the bank account. But hold on, right? Tortoise or the hare? You know, you got to think about this. What one wins the race? Let's keep going. Second year, the bank account has $60,278. The policy has $57,000. I'm down $3,204. But you see, as I go into this, and I'm just going to kind of run the numbers start to go in my favor. And by the 8th year, that number is in my favor to the tune of only $327. Now, that's not a lot. But you see, the numbers were so close as I'm going, a few $1,000s difference the entire way. Between two and my highest was $5,663 difference. So here's the narrative that I wanted to make. For that difference in those first 8 years, what did I get? Two things that we're not considering. Because I'm giving you numbers, I'm creating a narrative, but I'm not giving you the whole truth. Did you really make 9.25% in your bank account? No. Do you know why? Said it earlier. Who can tell me why you didn't actually make 9.25%? What happens in a bank account every year? That's right. Eduardo said it, taxes. You had to pay tax every single year on this. So every year, taxman took a piece of that. But over here in the policy, whatever you made, you got to keep because it was tax-free. Factor number one. Factor number two. In the policy, did we or did we not have a death benefit to protect our family the whole time? Oh, yes, we did. $1,174,238 is my death benefit, for which has a cost. Now, go to the most common thing you hear Dave Ramsey and all the other gurus talk about. Buy term, invest the difference, always wins. Okay, great. Math be my guiding light. Let's prove that one mathematically. Always, what they say is buy term, invest the difference. Great. So let's just say I made more in the bank account in the first 7 years. I was ahead. So let's say I now took the money, I put it in the bank account, and now I took it out, I went out and I got term insurance. I did the math. I went in and I said, how much would it cost for term insurance for a policy that would give me the same amount that that whole life gave me for the difference? Okay, so term insurance would cost $2,875. Okay, so when I really break it all down and I added it all up for those 8 years, that's $23,000 or 830. How did I do this? I did some math here. 836, I think, was the difference. But let's just say $23,000 it cost me over those years. Who's ahead now? So number one, I didn't factor taxes here. So we already know that this number is wrong. It's less because you paid taxes. But the other thing you got to factor in is term insurance has a cost. $2,300, I think, was mine. But let's just even see you could get term for $800. In the 7th year or any of these other years, the difference was $2,500, $3,200, $2,500, $56. If I were to average all those out and I were to figure out in those first 7 years what was the average, it was probably somewhere in the high 2,000. Let's call it $3,000. So it cost me about $3,000 for 7 years for that $1 million in coverage. That was the difference between the savings account, which is almost like it's less actually in most cases than what the term cost me. So see, now if I put term on with that savings account, I'm ahead of the game with the whole life. But you see, the difference comes right here. In this 8th year, my policy outperforms the bank account. It never looks back. And it doesn't just outpace it by a wee little bit anytime after that. The 8th year is just a squeak over $327, but then it's $5,211. Then it's 11,000, 21,000, 32,000, 44,000, 58,000, 73,000. That's a huge difference, folks. That's the difference between you making 14.67 cumulatively or 35.24 cumulatively. You see, the person that takes the whole life option, and I'm not even showing taking any loans from this. Now, if we took a loan from each one of these, okay, and we invested that money, now the whole life scenario blows away. I'm simply giving you the math. There is never, ever, ever going to be a situation where this scenario, from a math standpoint, doesn't win. Never. So when we come back to looking at the whys of why would I do this, I don't know how much more I can prove it. But if we just then add this process, pay your debts off, invest in real estate. I'm not giving you investment advice. You can use PMC Wealth for that. You can hire an advisor at PMC Wealth. We're going to have Stefan come on in a little bit just to intro what we're going to be talking about. We're going to be doing some footage and some trainings with Stefan. Really awesome stuff. But we'll intro that in a little bit. But real quick, Craig, let me turn this over to you. If you don't mind, can we just go through and show them a little bit more math? Because it's a really compelling story when you start to look at the 4 minus 6 or the 4.6 or the 5.9 and 6.75. How does that pencil? And why is the vault the vault really shouldn't be an option for any of you? Sorry, Craig, I'm stealing your thunder. The vault should be mandatory. Every single person using their policies for the infinite banking concept should buy the vault. And I'm not saying that because we own the vault and I want your subscription dollars, although I do. It just makes sense because the vault literally is your central operating system. It's your GPS. It consolidates all your policies like Boosie does. But it gives you all the mathematics and all the tools and everything else. And listen, some of you maybe look at it and you're like, oh, it's a little too complicated. It's got a lot of things. We're simplifying it. What's the word? Before I go to the grave, I will make sure I Steve Jobs the vault. It will be so simple that literally you'll just look at it and it will just do what you want. Just kidding. But take it from there, Craig.
I trust you. I really think that's going to happen because you've got a couple of engineers building this. Now we need the Steve Jobs come in and top it off. So, all right, let's get into some of the math in the vault here. Let me share my screen out, and I just need you to authorize me for that.
Oops. Sorry about that.
Yeah, no
I was getting so caught up in some of these comments over here, which are awesome. They're like, oh, but once you get over the FDIC limit, the bank becomes risky. Darn right. Not the policy, though.
All right. Chris, you see my screen okay?
Got it.
So one of the things I want to share with the community too, just about the vault is, you think about, I think Brandon from Busey mentioned a client that had, or someone he knows that has 80 policies. Well, whether you have 7 or you have 10 or you have 5, we have Bucky Doe here that has 15. Another purpose of the vault is to be able to catalog and store all of this so that you can look at an aggregate of your cash value. So if we think about our policies, or all of our policies as our banking system, how much do we have in capital available? So in this case, Bucky Doe has 15 policies. We can see their, total premiums. We can see their, total death benefit for their family. We can see the amount of cash value available. So the vault does serve that purpose as a catalog, as a way to understand where my policies are, which ones do I have, who's insured. And so then we can kind of see a breakdown of our total cash value, what's utilized in terms of available in loans, what policies we have sprinkled across different companies. So someone asked earlier, hey, what companies do you guys use? Well, it could be Lafayette, One America, Mass Mutual, Guardian, Security Mutual Life. So there's lots of different companies that we do business with. And then we can also look at that death benefit component that Chris was talking about, and that I love that savings versus the whole life savings strategy because the death benefit is a huge piece of that. So anyway, this is one of the things the vault will do is just help you to catalog and keep track of all of that for you. Now, what I want to do is jump into some of the loan math. And before I jump into this example, let me just do something basic here real quick. So Chris, we've heard that Lafayette, for example, is at 6.75, right?
Yep.
And the real question is, are we paying 6.75 if we take a loan from our policy? Is that ultimately what we're going to be stuck with? And so let's just say we're buying a thing here and we want to do a 5-year payment on that $10,000 loan at 6.75. So what we'll do for the next 5 years is every month we're making a payment, a loan payment back into our system of 194.86. All right, so we have 60 payments. These are our total amount of payments. This is our total interest. So although our base APR is 6.75, we're really paying 3.37% effective interest. So if we take that 1685 divided by the 10,000 divided by, the 5 years, it turns out we're paying pretty close to 3.37 in interest per year, not 6.75. So that's the first thing to really grasp. And I think a lot of people might have a headache just thinking about this, but what's going on here is we're paying simple interest. So every one of those payments, every one of those $194.86 premium loan or loan payments is going to reduce the principal. Then the interest gets calculated and set to the side. You do have the opportunity to pay that loan interest at the policy anniversary. Most times, like what Chris does with his cash value lines of credit, I just roll that to my balance and just keep paying that 194. So if we look down at the chart, you'll see here that every payment of 194 ends up reducing our principal balance by $194. And then that interest gets calculated on the side and accumulated to the side. So anyway, that's the first thing we really want to understand is when we're paying loan interest, we're not really paying that full 6.75 if we're being an honest banker and we're doing that bottom half of the diagram Chris was talking about and paying the loans back. So that's a really important piece to remember. We want to make that full circle around the diagram. All right, Chris, anything you want to add to that?
No, I think that's great. Anyone have any questions on that, what he's showing? Pretty self-explanatory. It's not 6.75%. It's 3.37. That's the biggest thing you need to point out, or the biggest thing you need to realize.
Yeah, and that's just going to vary, based on the loan, the interest rate, how fast you're paying those payments back. Now what I want to do is kind of overlay that with using an actual policy. So let's go ahead and pick a policy from our policy selector tool here. And of Bucky Doe's 15 policies, let's just grab this one. It has enough cash value in it to do my job, so I'll select that. Now what we're going to do is we typically start with loan planning. What do we want to do with our loan? How much do we want to take out? How long do we want to pay it back? But then we're going to move into what we call the personal loan planning. And this is where I want to shift over to my other screen here because I want to do an example of, let's say we take out 25,000 at 5%. We're going to do a major purchase. We're structuring that over 60 months. So our payment now is $471. So nothing's really different here. Instead of having a 5% interest rate, we're at 2.47. This is the way the math works out on this one. So when I select a policy, I'll use that same policy and we'll go into our loan planning with the policy. So this is where, if you know the Bucky Doe family, there's Goldie, the wife, there's Minnie, the daughter. And so let's say that Bucky Doe, the dad, is going to offer his daughter, a $25,000 loan so she can buy her first car. Now, what's going to happen in the Bucky Doe family is they're not just going to say our policy loan's 5%, so we're going to give Minnie Doe a 5% interest, but we're going to charge Minnie Doe 7% for the loan. That's what perhaps Minnie Doe would get at a bank, or maybe it's probably going to be higher, but let's just say 7% is the number we're using. Now we're also operating with a policy that we've had for a couple years. So we've gotten over some of the initial efficiencies, and I'll kind of show you what the difference is between a brand new policy versus a policy that has some efficiency or age to it. So this policy has a couple years into it when we take our loan. So when we start executing that loan, what I'm looking at is at the end of that 5 years, Bucky Doe would have put $50,000 of premium deposits into his own banking system. So that's our savings, and we're just going to continue putting in those premiums every year. While we were taking a loan, that $25,000 loan, regardless of the loan or not, this is a non-direct recognition, which means when we take a loan from this policy, it will not impact the dividends. There are some companies where that is not true, but this This particular policy is with a company that won't consider our loans. They'll give us our full dividend crediting. But isn't that cool how we put in 50,000 of premium and our policy grew 57,868? So we have almost $7,000 of growth there. By using this system to offer the $25,000 loan to Minnie Doe, we actually end up, as a family, we end up getting $1.12 back for every dollar that Minnie Doe used to buy that car. So this is just highlighting a lot of the math that Chris was going through the board, because one of the things Chris was showing is the cash value growth. What we didn't show is what happens if what if you take a loan from that policy, or you interrupt the compounding of that savings account? You've just put the brakes on that interest that was being accumulated. So anyway, between these two, we're just simply showing, here's the economic benefit. You're getting $1.12 back for every dollar you spent on that car. So here's how we're almost making money while we're borrowing that money from our system.
And I love how it shows the spread, because when you're thinking about banking, that's what it's all about. It's about what spread is the bank making, what spread is your bank making, and it just tells you right there, 2%. I mean, that is not a small number when you're talking about it, because you're making money twice here. You're making money on the policy, which is that recaptured, 112, so $1.12. If you put $1 in, you got $1.12 back. Is that how you'd say
Yeah,
that?
so that's kind of the way I look at it. You put $1 in, you got $1.12 back. So
12.1% cash on cash is how I'd look at that.
Yep. Now we compare that to traditional financing. If Minnie Doe, we just said, hey, Minnie, go out to the bank at 7%, then she would have spent 4701 on interest, and $29,701 is gone from the family. So I wanted to show what it looks like with a policy that's a couple years old. But what if we go back, and I'm going to change the start date, because I'm going to assume, let me see if I can get that typed in properly. Let's assume that my policy is relatively new. Maybe I'm in my first year of operation. I just want to show you what happens. Instead of recapturing 112%, we captured 96%. So the only thing I'm highlighting here is that we put in 75,000 of premium. Our cash value gained is 74. So this is no different than what Chris was just showing in his example. There's a point in time where we have to get efficient, but I would still posit or say that I'm happy getting 96 cents of every dollar back of that car we purchased, as opposed to losing 29,701. So this is the math behind the scenes. And when you think about, this might be your first car purchase, and maybe we do many car purchases over time, and maybe now our policy's down into 2030. So now we've got many years of efficiency, 125% recaptured. So the thing is, when you think long range, you're just going to have a system that just keeps paying and paying and paying more. I mean, we put in 50,000 over that 5 years, but our cash value grew to the 64,747, and we still have a big death benefit, and we also gained almost 86,000 in death benefit. So it's just, when you start playing with the math, I just don't see a better way of building a banking system than using this to store your savings and then leveraging it for car purchases or whatever else you want to do with it.
Let me just go one step further, Craig. I just want to talk about this exact scenario. I mean, people all the time open businesses. And when you open a business, your business usually isn't profitable until usually, what is it, 5 years or so? But let's say you get really lucky and it's 3 years. So again, you gave up 3 years of potential gains to get for the rest of your life in a business scenario. Let's talk real estate. A lot of real estate investors, they buy a rental. Okay, in the first year of the rental, typically they got to put money down. Sometimes they got to put capital money in to get the place there. But nonetheless, I don't know many rental real estate deals or any real estate deal that's profitable in the first year. A lot of them not even until the second or third year. Okay, so you're giving there. But yet real estate is known as the greatest investment you can put money in. It's always over time gone up in money, and it's one of the best places, best, easiest ways to become a millionaire. But I always say, yeah, but what if you started here first? What if you changed where that money went that was the down payment for the property? What if you changed where the money went that was the renovations to the property, and you put it here? Then you bought the real estate. Okay? Both of them are going to take a couple of years to hit to that efficiency point, but now when they do, Now you're working with extra. Like you're not working extra. Your money's working extra hard for you because now you're making money twice instead of once. Like, and all you did is changed one thing. This is sometimes when I'm talking to people, when I'm in a debate kind of scenario, I'm just like, what don't you understand about this? Like, what part of this is complex for you? And I can tell you what it is. Before they even tell me, I already know. In their mind, they've got it predetermined that whole life is just a bad place. And you know who a lot of these people are? No disrespect, so please, like, don't take this as offense to any of you if you're on here. Doctors, surgeons, like, they're the worst, and professors, because they just, for some reason, have such a negative wall that's built in their mind, this limiting belief that whole life is the worst place. But by the math, we literally just showed you by the math that it is definitely not what you think. It is better than what you thought. So it perplexes me sometimes that some people are, they get interested in this, and then you get into the thing, and then all of a sudden they're like, I don't know if this is going to make sense for me. Really? What part of math doesn't make sense for you? Because like that's all it is. By somebody saying this isn't going to make sense for me. Now there's other factors. Now, bear in mind, there's other factors. Like maybe right now the cash flow is not there. Maybe whatever. There's a lot of factors. But if they say this isn't going to make sense by the numbers, I just called your bluff. And I'll go toe to toe with any CPA, toe to toe with any financial advisor. We have many times, because math doesn't lie. And if a CPA or an advisor can come on and prove our math wrong, game on. But they're not going to. Especially today, because all this math is not just our math, not just calculators, but it's also AI double checking everything. Now, I know AI is not always right when it comes to math, but what I'm saying is that, like, the math is right. Trust me.
Yeah. So Chris, one other point, just in terms of structuring these loans, one of the things we're taking it a step further. So if we want to execute this loan, there's two things I really think about. One, if we're going to loan mini dough money through our family system, one, we're going to do it with a promissory note. So even though this is family, mini dough is getting a loan from the bank of dad. We're going to structure this as $25,000. This is the amount of interest that mini dough is paying, and we're going to treat this like a real banking system. And in addition to that, we're going to allow for these different policy loans to be tracked in our family system. So we may have a loan for, if I execute this loan, we'll have a loan for mini dough for a car. Maybe we did some big major purchase. We're also tracking that. I guess I bought an antique waffle iron. I'm not quite even sure why I put that in there, but I've got multiple loans because this is money that came out of my, our family banking system. And we're tracking as I take loans and I pay them back, just like in a bank account, how much available cash do I have to continue to use again? So if Chris comes to me and says, Craig, I just found this amazing opportunity. Do you want to get involved? Of course, we have to do our due diligence. I have to go look in my system and go, well, yeah, I've got $389,000 I could deploy. What do you have, Chris? Or maybe I see this really cool 1941 Willys, which I'm really wanting to get, and someone has to fire sell it. They, in a weird situation, like, yeah, I've got 389,000 here. Maybe I'll buy that 41 Willys and put it in my garage. So anyway, the whole idea is we're allowing you to plan your loan and then put the policy directly onto that loan and execute it and then manage it going forward. So those are all the steps that we're doing with the vault in terms of policy loan management. So whether you're using a cash value line of credit, whether you're using the vault to manage multiple policies, 15, 10 policies, 7 policies, 5, it doesn't matter. This is kind of what we're building in there. So Chris, any questions we have? I know we're a little over time, but
yeah, we started at 5 after, so we're pretty much right on time. I'm just, if anyone's interested in checking the vault out, trying it, watching some videos on it, I just put that in the chat. So you just go to BYOBvaults.com and you can try it out. I believe there's still a free trial period if you really want to kind of get in and start entering your stuff. You can use the Debt Blaster to kind of see how it would work for paying off your debts, but just start using it. It is one of the most powerful tools ever to hit the privatized banking, side of this business. And Edgardo, I do want to hit on that question. So Edgardo was asking, how do you track portions of your cash flow that are earmarked for things like taxes, tuition, and emergency funds, even though they're all technically part of the total cash value, but not available to spend? So how I do that, Edgardo, I've gotten pretty good at siloing my policy. So I'll give you an example. Me and my wife, I don't remember how many years ago it was, we got the idea we wanted to remodel our master bathroom. We still have not gotten to it because it's a messy job, but that was our goal. And we earmarked how much. We had a contractor give us a quote. We said, okay, we need this much money. So what I did is I said, all right, I need to put X amount of dollars away for X amount of years to get that much cash value to pay for this bathroom. Because my wife, which she does infinite banking, but she's like, we could just use the line of credit, which we could. But I'm like, yeah, but I'd rather use the policy because then my money's still going to earn for me. So the policy was set up specifically for that goal. And I'm always, just so everybody knows, I'm always trying to get more death benefit. I am literally on a perpetual battle through my life, fighting the clock every single day, trying to get more death benefit so that I have more money for my, future family banking system. So when I'm gone, so I'm always counting death benefit, probably more so than most of you. I want more death benefit. So this is just another excuse for me to get more death benefit, but also, make my money work for me. So Edgardo, when you're doing yours, that's one way to do it. The second way would be to use the vault, put all your policies in, earmark the policies. You can actually name those policies and name one tuition, name one taxes. And the last way is just simple. Just keep an Excel spreadsheet of how much each of those items are. You know what your total cash value is, and just update your cash value once a year or whenever your policy anniversary is, and just say, okay, this percentage of this policy's cash value is earmarked for taxes. This is for tuition. So there's really 3 different methodologies on how you can do that. I'm just trying to share how I do it. Hopefully that was helpful.
Yeah, and one of the ways too, Chris, I'm just kind of thinking through is, if you do have money earmarked for a particular thing, taxes coming up, just go ahead and create a loan for it. It'll take it out of your available cash value. You don't have to make any loan payments on it, but it's just reserving that cash value that you're not going to be able to use for other opportunities. So it's going to, every time you configure a loan, it's going to take from the available cash value and earmark it for whatever you want it to be. So this could be, instead of this antique waffle iron, maybe this is reserved for my April tax bill. And when I pay it, I just go in here and mark it in, pay it, or I just keep it that way just to kind of hold that cash value back.
Oh, Edgardo, I like Craig's answer better than mine.
Yeah. Yeah, I love a good spreadsheet. I mean, I do, Chris, but I'm really trying to get more and more of my own stuff into the vault too. So
love it. So real quick before we end, I wanted to bring Stefan on. Stefan runs PMC Wealth, which is a financial advisory firm, a registered investment advisory to be specific. And, I've spent a lot of time with Stefan in his past. He's done some just amazing things in the financial space. But one of the coolest things was when I spent 16 years in this space, in the RIA space, and I saw a lot of issues, and I talk about them openly and honestly all the time. The problems with the traditional, I call it antiquated financial advisory world, where people have assets that are not managed by their advisor, like their 401k, that they need advice on, they're not getting it. Their advisor maybe only calls them when they want to sell them something or, do something, that benefits them. There's just so many issues. I could go on for days. And when me and Stefan got in the room, I was kind of a little standoffish because Stefan's resume is like none you've ever seen. I mean, from the college he went to, Ivy League, to the firms he was at, to what he did at the firms, and I call them almost miracles he was able to pull off. But the thing that I always got into with him is I'm like, oh God, I hope I don't offend him. Talking about the problems I think the financial advisory world has, the problems that we want, to solve with PMC Wealth and what Stefan and Brandon are running. And the funniest thing was Stefan was like, oh my gosh, yes. These are issues I want to solve. These are issues I talk about all the time, but nobody in the financial world wants to hear about it. So what we're going to start doing, folks, and this is why I brought Stefan on, is we're going to start bringing him on wealth webinars, because I can't give financial advice, nor can Craig, nor can Chris, but Stefan can. And he can talk about things that I can't talk about to all of you. So we're going to bring a whole new dynamic to Wealth Webinar and YouTube, where we're going to be talking about financial advisory stuff that has to do with your investments. Like, yes, financial advice. And I wanted to just quick have Stefan come on, talk a little bit about next week and the podcast we're going to be doing, because I think all of you and then all of your friends should join us. So Stefan, tell them a little bit about what we're doing next week.
Thank you for teeing me up. And, like you said, I spent the last 10 or 15 years of my career as a leader at a number of different investment advisors. And last year when we met, Chris told me about the project he's working on to create this new type of financial advisor. And just like he said, I instantly smacked myself in the head and I was like, this is what we wished we could do at every place I've worked. And once I saw the vision and the passion and the potential that this idea had to transform the industry, I knew I wanted to be a part of working with someone who's actually doing it. And so fast forward to today, I'm delighted to be talking to you all, to be a part of the community as we launch PMC Wealth. This is going to be a new type of financial advisor firm that is transparent and focused on providing unbiased fiduciary advice to investors like you who might not be able to get the type of financial advice on real estate deals, private lending, and other things for the reason Chris was talking about. Advisors don't get paid on it, and a lot of places will discourage it as selling away. So I'm excited to start talking to you. We've planned a lot of content. I'll be talking about my experience in the financial planning industry. And next week, we'll be talking about the economy, the Fed, bonds, and whether or not that might fit in a real estate investor's financial picture. I'm really excited to be a part of this community and hoping all of you will join us on the webinar. And please bring your questions. I look forward to getting to know all of you.
Awesome. And I know you've already worked with a bunch of clients already and many more to come. We are literally just kicking this off. So if you haven't heard about PMC Wealth, it's not because you missed anything. It's because you're just now at the starting line, because that's where we're at. So we're really excited about it. And Stefan will have a lot of really amazing stuff next week. So make sure you block it off in your calendar, 1 p.m. Eastern, right here, right then, if that's how you say that. Thanks, Stefan.
Thank you.
All right, folks. Well, I know we went a little bit over, so just kind of want to do a recap. We were talking about CV lines of credit. We had Brandon from Boosie come on talking about why it may make sense. And it's not replacing IBC. I do want to preface, using the bank, using the CV line of credit, we are not replacing traditional IBC methodology that we talk about. We are simply enforcing it. We are giving you a different path that simplifies and also accelerates what you're doing. And again, it's not a fit for everybody, but for those that were like me, it's probably a really good fit for you. But now with the Vault does all the consolidation for your policies and will give you one global look of all your stuff in one centralized place. It's just a matter of just tracking and making sense of, does it make sense to have one central place? For me, it does. Even though I pay a little bit more in interest, Craig showed you that I'm playing the APR game, not the stated interest rate. So those are really important things. So get a hold of Brandon over at Boosie. It's brandon.miller@boosie.com or just boosie.com. And then PMC Wealth right there in the chat. So you've got a couple links, okay? So you've got a link there if you want to book a call with one of our mentors to learn about your journey with the infinite banking concept and getting started with your own banking system. So we're happy to do a call with you, talk about your policy designs, your situation, and what problem we can solve for you. So if that's the case, right there, Stephen just posted it, mentors.beyourownbanker. Click that link, book a call whenever it's convenient. And right above there, if any of you are so excited about PMC Wealth, talking to one of the advisors at PMC Wealth about your investment situation or financial planning situation, there's Stefan's email. Feel free to email him. He's there for you, folks, and then you can kind of get around that campfire. But with that being said, Craig, thank you so very much for all that you do with the Vault and for all of our companies. And same thing, Stephen, thank you for what you were doing. I know you were typing away like crazy, but Stephen, I know we've got one final thing we have to tell everybody. We've got an amazing event coming up. Can you just real quickly tell everybody about Blueprint?
Yeah. So it's basically, everything we teach about taking back control of your money, solving your money problem, a true financial education. Once you start learning about the infinite banking concept and how money actually works and understanding there's a better way out there than the traditional things we've always been taught, like having a 401k and listening to a financial advisor and all the rest of it, you're really going to start wanting to go down some rabbit holes and learn more and more and more. And so we put together 3 days of education from all of our experience, stuff we've done over the last, several decades, combined and bringing it to you in a 3-day virtual event. We call it the BYOB Blueprint, because the goal of this 3 days is to allow you to understand and start to create a plan for yourself, for your personal situation on how to become your own banker. And that's why we call it the blueprint event, because you're creating that blueprint, that roadmap, that GPS for exactly what that looks like for you and your family. So we're doing the first one of 2026. We're going to do 3 of them this year. The first one of 2026 is the end of this month, January 30th, 31st, and February 1st, the Friday, Saturday, Sunday. The VIP includes a workbook that we're going to mail to you so you can follow along with everything, as well as some other bonuses. You also get the recordings that you can keep for life, so you can go back, refer back to those, things of that nature. So join us. I think it's $47 or $97 for the VIP. So less than a night out to dinner, and you get life-changing financial education. So I'm really looking forward to the event, though, because over the years of doing this, that's the one that so many people come back to us and say, hey, I started with your 3-day virtual event. I started with your Money School Essentials event. And that's exactly what we're bringing back for 2026, and super excited for it. So grab your ticket, get it locked in, and it's going to be a really powerful weekend.
Awesome. All right, folks, with that being said, thanks for joining us for Wealth Webinar. We will see you this afternoon for Ask Me Anything at 4:30 Eastern. You can get there by going to my YouTube at The Chris Naugle, and just make sure you smash that little bell. That'll notify you when we go live. Till then, we'll see you next time.